The rising inflation in Singapore is not a new story. In fact, it has been on an upward trend since September 2020, where it was close to 0% as the world economy was brought to a standstill by COVID-19. But in 2022, over a span of a few months, exacerbated by geopolitical tensions, China's zero-COVID policy, and interest rate hikes by the Fed, headline and core inflation both hit new decade highs in August and are expected to remain high, only easing off towards the end of the year or early 2023.
Is high inflation the new normal? I actually hesitate to say anything is the new normal these days because it can be very easily outdated. I think higher inflation is here to stay. We are not going back to the days where Singapore enjoyed like 1%, 2% type of inflation growth.
The decade of low inflation and attractive interest rates that propelled the growth of Asia and the world looks set to be a thing of the past. In the first of a two-part episode, we'll take a closer look at the factors driving this round of high inflation, how countries and economies are adapting, and what can we expect with high inflation as the norm. In Singapore, inflation is measured by the Consumer Price Index, or CPI, which tracks a fixed basket of goods and services. Headline inflation, also known as CPI all items inflation, covers all items in the basket. Core inflation leaves out two components, accommodation and private road transport, to provide a better measure of underlying price pressures. So what does a headline inflation of 7.5% actually mean?
So Singapore's inflation currently running around 7% handle. It's actually one of the highest in ASEAN itself. I think one of the reasons for that, of course, is because we are a small open economy. We buy most of our goods and services from overseas. And because we have a very tight labour market, the prices here is actually fairly transparent and is really driven by market forces. Indonesia and Malaysia, they have also seen inflation prices tick higher. But because they actually have a host of subsidized prices for fuel and food, and that's why their inflation is a little bit better anchored compared to Singapore.
Inflation in Indonesia and Malaysia for July was 4.69% and 4.4%. The Malaysian government is set to spend close to 22 billion Singapore dollars in subsidies to temper rising prices of commodities and goods. Inflation hit a 14-year high in Thailand, crossing 7%, prompting plans to raise wages and policy interest rates. South Korea's central bank also raised its policy rate to 1.75% and lifted tariffs on 7 key commodities. On the home front, the MAS has tightened monetary policies 5 times in a series of pre-emptive off-cycle moves to reduce the costs of imports. And the Singapore government has also committed a support package of 1.5 billion Singapore dollars to help vulnerable groups and businesses cope with soaring energy costs. Why is this round of inflation hitting economies harder than before?
Well, I would characterize this round of inflation as a little bit of like an inflation storm. And let me explain. Because you have both supply and demand factors that are driving up inflation, right? First was COVID, and then on top of that, this year we basically had the Russia-Ukraine war, and Russia is a big supplier of natural gas, and Ukraine is also a big supplier of wheat and other types of commodities. So we basically have seen commodity prices shoot through the roof, and then nobody knows when China is actually going to lift its zero-COVID strategy as well. And then if you look at US-China relations, it still remains very challenging, and because a lot of the foreign workers have returned home during the pandemic, and they are not coming back as quickly. So it's kind of like there is a manpower shortage, and that also drives up costs. So both demand and supply factors are kind of like creating that perfect inflation storm.
As an open economy, Singapore is vulnerable to volatile shifts in the global macro environment. And with the US Federal Reserve continuing to aggressively hike interest rates to tame inflation, how has that trickled down closer to home? Prices of food, electricity, and petrol have risen sharply, but the increase has been gradual.
Initially, when inflation started to kick in, right, when you start seeing your bills go up, you are of that mindset that, oh, maybe it's just a temporary thing. But this temporary has been longer than what you expected. So we're starting to feel the pain because it's been a few months and it's not really going away. The bills are still high. Maybe high inflation is what we have to deal with now since we came out of a period whereby we had very low interest rates. Too low for very, very long. Yeah, it's not like you're necessarily paying more for, let's say, your nail manicure or your haircut. You don't really feel that yet. But when you buy things, that's where you see the difference. Like, oh, my kopi peng used to cost like, 180 and now it's 250. Or like, oh, it's still 180 but the cup has like downsized by 30%.
Despite the cost in manpower, rents, and goods going up, businesses seem to be coping. Gross profits have increased by 9.8% year-on-year on average. Businesses are still profitable and are further aided by government subsidies.
So families feel the pinch the most for sure, especially if you have like younger kids and older parents to take care, whereby you tend to generally spend more on cooking and groceries. You want to make sure the food is a bit healthier. They would feel the most rise in terms of groceries because they're already spending a lot more in that area. Yeah, and I think, to suddenly see your bills go up by 20 to 40%, it can be quite shocking, especially if you're not prepared for it or if you don't have the financial means to adjust to that. Because with inflation, naturally what happens later is wages have to keep up. When wages kicked in, that's where businesses will then pass the cost down to the consumer. So that's likely when maybe in a few months' time or maybe next year, I won't be surprised if we really start to see all the school fees and whatever other services-driven kind of elements start to go up.
Will Singapore be able to weather these inflationary pressures? There are signs of recovery in 2022, but the outlook for 2023 is not so clear.
Manufacturing momentum, especially on the electronic side, the chip side, is starting to slow down. But that said, we've had a very nice long run over the last 2 years. So it really now boils down to how we see the services sector performing. So I do expect that growth momentum, whether it's in your hospitality, your aviation, your MICE events, or even your F&B and retail sector, I think we should see better and improved sentiments. I think the bigger question really is what happens in 2023. Because you look at this tug of war between inflation and recession, there are genuine worries that the US or even Europe and UK are basically heading into a recession pocket.
In part 2 of Investigating Inflation, we'll look at the possibility of a global recession.
UK, for instance, they are expecting to basically go into a fairly prolonged recession from the fourth quarter of this year.
The repercussions of a strong Singapore dollar.
In terms of cons, it's a bit of a double-edged sword, I would say.
And how families and the everyday person on the street can adapt to a rising cost environment.
From a financial standpoint, it's simple. It's either you spend less or you earn more.